Well, hello, TATodayers. This is the weekly review for the U.S. May 31st, 2020. If we look at what happened last week, it was kind of the same story that we've been having for a while, and that is that we saw a continuation of the move to the upside. 3% on the S&P here. We saw a good-sized move in the Russell as well, almost 3%. Pretty much flat on gold. Down on the dollar, down on the junk bonds, up, on the regular bonds, treasuries, up on the junk bonds. So a good performance overall again, another continuation to the upside. Now if we look at here at the indexes, the sectors within the indexes, the thing I wanted to note here is that you're starting to see some good rotation. If you look at some of these sectors, now not all of these have underperformed, but a number of them have comparatively. Basic materials, finance, especially industrials and financials. The utilities actually had a great week again. Healthcare actually picked up this week. They were down last, but pretty broad participation if you look across the spectrum here. So that is a good thing. It's a bullish thing again if you are interested in being long this market. I want to back up and use the idea neoclassically is like, how do you know that you're in a strong market? You begin to tell, early on. So like, here's the low that was hit back at the end of March. You had that big fast move up and then a retrace. That retrace does about a little less than 50% of that move up, holds, and then shoots back up here, breaks out. The way you know that you've got a bullish trend, and that trend is strong, and it's true of bearish on the way down here or on bullish on the way up, is that you see that you can't print a swing point high. For example, this doesn't print here. This one can't print, that one can't print, even this one, right, where you actually get a decent pullback. You're up and over it before it can print swing point high. You finally get one after what turns out to be from roughly 2200 up to 2900, so a 700-point move before you ever print a swing point high. And then you eventually break it, you get the retest regen here, and you take off again. This is a very strong trend. How long will it go? That's a different question. But the fact that you can't print a swing point high where you start printing all these lows on the way up, and we're on a daily chart here now, you should see usually 3, 4, 5, 6 swing point highs on a daily chart. When you can't print them, that's a strong market. You also can tell if it's a strong market if you get these things that I call form, fire, and fulfill. I borrowed this term from a good friend of mine that uses this idea of forming, firing, and fulfilling those specific terms. And essentially what he says, Charles Kirk says, is that if you get a move up, right, and you set up some sort of a bullish structure and it forms, so in other words, here you go up, you retrace, and then you set up, in his case, he uses a lot of cup and handles. You set up sort of a cup and handle here and you break above it, right? So you form something, you flip, and you go over it. Now in my case, I don't use the cup and handles, but we can use the same idea, and that is that in this particular case, what we see here is we see a move up, right, down, and then back up again. When you cross over here, that's an ABCD structure. You have an A point down here, you have the B at this spot, right, and you have your C point down here. And so when you cross over the B, you've got your projection up to your D point. And so, whatever you're using for your structures, your projections, you need to see these things form, fire, and fulfill. And so you can see here, this made new highs. You go up, you come down, you try to break a swing point low here, and you can't, right? You can't break it here, right? Here you get a breakout of above a bullish breakout on, finally prints a swing point high. You get a retrace into it, and then what do? You regenerate. right? These are all form, fire, and then eventually fulfill. We've got a couple ABCD structures that point up to the 3130, 3160 area, right? If it hits those, if it finishes off up there, that's the fulfill point. And it has finished other ones on the way up already. And so those are form, firing, and fulfilling. Anytime you see trend setups repeatedly do this, and then conversely, if you see them can't do this, right, that is what you call a strong trend. And that is a strong trend. This is, no doubt, this has been a very strong trend and continues to be until we start to see bearish scenarios set up. They form, they fire, and they fulfill. And when you start seeing this, and you can do it on a 30-minute time frame is usually the least I go to, and then a daily time frame, and they do it in such, it's always done in terms of time. There's a 30-minute that will start doing it first. Once you see a few of these happen, you'll see some dailies set up and do it, and eventually it moves to the weekly and the monthly. So, it's in terms of duration of time, starting with the least amount of time and working your way up. What's the technical picture right now, right? The most nightmarish scenario, which I talked about 2 or 3 weeks ago, that has started to come true, and that is that we see a continuation to and above 3,000. In this last week, we got over 3,000. As part of that happening, what we should see, and we're probably going to see, is the index going to hit all-time highs. S&P is going to finish also those ABCD targets, 3133, 3160, and we're going to see the Russell fill the weekly gap and test into those bearish retest regions. If you look at percentages, you got about 2% to go on the NDX, about 3 on the S&P, and another 1 to 3 on the Russell. This is happening, folks, this nightmarish scenario, and that is, and I call it that because what's going to happen most likely is you're going to see this market work its way up. It's going to blow out all the stops on the shorts, right? They're going to give up, and when they finally give up, this thing's going to roll over, and so the shorts are going to miss the move back down that they've been trying to trade for, and the longs are going to get pressured back to the downside and have to make a decision. Do they sell on the way down? That's the nightmarish scenario I've talked about. That's what's starting to form and fire. It always does its best, right? The market tries to let the fewest amount of participants trade in the move, whether it's up, whether it's down. It's usually the way it works. If you look at that, right, and think about it, and I've got the weekly up here on the S&P, on the way down, right, you break a swing point low, and if you were following me way back then, I told members, here's where you want to try to sell it on the bounce back into a retest regen. So you got this big spike down. We said, lighten up here, and then you get that move down, but you don't get much of a chance. You have to make a lightning decision. You have to go with it. And if you do that, then, and if the market actually does do what could happen, then it looks like, oh, wow, I did really good, right? But you don't get much of a chance, right? There's not a lot of great entry or exit. I should have said exit here as well, right? There's not a lot of great entry and exit points on the way up and on the way down. That's usually what the market tries to do. It makes it fewer and fewer of these for you to participate in. So anyway, you get the fast move down, almost no entry, almost no exits. Now on the way back up, other than this little consolidation here, same sort of thing, right? Fast move off the bottom, a little bit of a consolidation where you could have got some entry points that were decent, and now the continuation move. And I haven't shown it, but there's actually an ABCD structure here as well, right? You've got, let me mark it up here, you've got an A point down here, you've got your B point sitting at this price point, the B point, now the C point here, and so take the distance from here, project it up, right? That's new highs if this bigger ABCD on the weekly actually forms, fires, and eventually fulfills. All along the way here, we've had this wall of worry, and we're adding to it. And this week we added to it with these protests and the riots that are starting to spread, both in terms of size and intensity all across America. I counted something like, I think, 40 cities, and that was the ones that were easily identifiable. It could have been as many as 50 or 60 easily. That I think is going to have a short-term effect on this market, and I think we're going to see that probably in the futures when they open up later on Sunday. The horrible economic data, right? The China bashing that's taking place. The administration last week starting to go after Twitter. They had already opened up the idea last summer, if you remember, monopoly type action against Facebook, against what were the three? Facebook, not Netflix, but Google and Facebook were the two primary ones. That kind of went underneath, the water under the bridge. Hasn't heard much more about it, but there's this kind of love-hate relationship going on with technology, and this is about free speech now, and a whole different rim of bashing. But again, we keep adding these things to the wall of worry. The COVID, with all this protesting and rioting, right? I would imagine the ability for this thing to flare up is growing, right? With all this taking place, and so I expect this is going to come raging back, even here in flare-ups all across the United States. And I don't know, another week or two maybe that we see that start to occur. Approaching the 30%. We've got unemployment numbers this week. The claims keep climbing, and I know they're climbing at a decreasing rate. So they kind of look like this on the chart. But still, this last week was 2 million on a weekly basis. The other thing is on the flip side of all this, like we said last week, is don't worry about it, right? Central banks got your back, and Fed Powell told us that again this week on a one of those nice little comforting interviews that he does, this time with a former Fed official. So it's little softball questions that he can knock out of the park every time he talks. But the central banks, the government's fiscal financing, deficit financing, as well as central bank printing money out of nowhere, all this stuff is what's propping these markets up, and I have a little graph later to show that. The demand, though, it's not coming back, folks. I see no way we're going to go back to 100. I think the question is going to be, is it going to be 80 to 90? In other words, when the demand numbers finally come back and we get to see them, and that's probably going to be in about, I think, another couple months, we'll see what this number really is, but I suspect it's going to be 80 to 90% of what we used to see. But even with this, right, this market can still make new highs even with this. Why? Because of this, because of the central bankers, because they got the biggest stick around, and they can keep just banging this market higher if they want to. Here's that chart I was just talking about. If you go back and look, and I've got this on a monthly here so you can see the last few years. Now, of course, there was a lot of Fed stuff that took place back from 2008 up until about 2000, primarily up until 2013. There was a lot of stuff that took place. Then we went into a big consolidation, 15, 16, and then we took off again. This was the Trump bump, right, off the elections. And then the Fed decided they were going to do kind of a no growth on the QE, some tightening. And that took place over a period of about 12 to 18 months. And during that period of time, this market went nowhere. Made highs, made lows, made highs again. And then what did we do? We got the no QE, if you will, QE4, whatever you want to call it, that bumped us up to new all-time highs. And then the COVID came about and dropped us down to new lows. And now we have Fed QE infinity as well as fiscal infinity taking us right back up again. And so, it's fairly clear. I don't know how you can argue against this. It's fairly clear to me that the central bankers are the reason the markets are where they are. I don't know how else you can describe this. This move here was about regulation cutting, about red tape stuff, about the hope of what could happen, but still, when the QE, even though the QE wasn't flowing here, we certainly weren't tightening, right? We had interest rates basically at zero, and then when we started to actually take some of the money train away, then everything changed. What's the bottom line? Same story here, right? Until the trend changes, you just got to go with it, right? And right now, the buyers still have control. And you'll see here in a second, I expect that probably to change a little bit this week. But in general, until the trend changes, you got to stay with it, right? So you got to find a strategy. If you're trading your own accounts, you got to find a strategy that fits. You always want to trade with the wind at your back. And that means you follow the trend. If the trend is up, then you want to be trading long. You don't want to be trying to trade short if the trend is up. If anything, you just move some of your money to cash when you think things are going to get bad. But you don't try to short stuff, right? That's a losing bet in most cases. If you do want to go this way, you wait until you see some sort of a top and you go hit the weak stuff. You know, maybe you go into real estate, or you go into the small cap banks, the financial, regional financials, you know, or some of the others that I've pointed out on previous videos. But you don't short the market, right? Because the market trend is up. You have to go find those places that are weak. So you always want to be working your strong sectors in stock along the trend. If the trend changes, you want to be working the weak stocks and sectors. The longer term trade, if there is any right now, it's precious metals. That's where the money's been flowing, and I suspect it's going to continue. There's very few places I can point to other than here. I've talked about silver. I've talked about gold. I think both of those are places you should be. I personally am and have been in a lot of the money that I manage. Everywhere else, I think it's trades. I think you keep trading them. You know, if you want to hold them, that's your business. If you got in early enough on this move, you can hold. Just keep walking your stops up. But if you're trying to establish new positions now, I think you got to be thinking about them as trades. You got to continue this strategy until there's real evidence that something has changed, right? And how do you know that? Well, you start seeing bearish technical setups begin to form, fire, and fulfill. Until you see this, right? The things haven't changed, right? Until you see this market do something to the downside where it not only forms an ABCD, it actually fulfills it, then you just gotta believe the other trend is still in effect. And it's after a couple of these, you see them on the 30-minute first, and then eventually see them on the daily chart, right? It's after you see a few on the daily, you know, a couple of them on the daily, that you can think the trend really has changed. But until then, trend's the same. All right, expect buyers all the way back to the 2740 area if this market pulls back. I suspect if you go, you know, it's 300 points. I suspect all along this area you're going to see buyers. I don't think that's going to change. And so I would be focused on the swing point high. The second retest regen doesn't have a great probability of holding, but I suspect it will get bought all the way down to here. If you start breaking multiple swing points, then things will change, right? But that's a ways down. I suspect that's going to be a ways out before that happens. Looking to the new week, you know, we're not going to see any numbers that's going to tell us anything about that 90% to 80, 90% type demand situation I was talking about for another couple months. We are going to start seeing some numbers that give us a hint of how good it's becoming compared to what it was. So the previous here on the market, this is a survey, right? But it is for May. Those numbers will come out this week. They're forecasting 36.4 versus 27. Remember, 50 is kind of the even mark. So anything under 50 is kind of contraction. So they're expecting this thing to come back up. If this number comes up and just sits at, say, 40 to 45, you know, say 4 months from now or 3 or 4 months from now, then that tells you you're definitely in a recession. You're going to stay there for a while. Services PMI also May, those will come out, another survey expecting numbers to be better again. And so I would be watching to see how good these numbers are to give you some indication of what this eventual number is going to probably be and what that general demand number is going to look like. Because if that demand number really is in the 80 to 90% range, right, that's going to be a real problem for this market. I don't care how much the Fed wants to pump it. You know, yeah, they can get it higher, but it's not like the market itself is going to take off on economics. You're going to have to just keep pumping and pumping and pumping. Friday, you get the unemployment numbers, and of course, they're expecting it bad, only 19.7. If that number prints 25, this market will take a hit. You got European, Australian central bank, Canada central bank decisions. Expect more of the same there. Really nothing happening on these two fronts yet. Last week we were expecting that the 3,000 would be breached and held. That's exactly what happened. We're starting to get this expectation back up to the best case. And if we look at expectations for the next week now, I'm a little bit more bearish this week. I actually think that the market is going to trade down, primarily off the riots, trade under 3,000 and probably stay there. It may or may not hold this swing point high. I wouldn't be surprised to see it actually close under it and then bounce back up into it. And what that would tell us is that what was up is most likely sideways. And that would tell you you're starting to put in some sort of a sideways, larger range sideways type action. Worst case would be a push back to that area that I talked about around 2,800. Best case, it probably just ekes a little bit higher towards those 31, 30, 31, 60 ABCD structures. And here's the actual details. That's it for this week. Have yourself a great one. Stay safe. I'll see you next time.